Hi, everyone, and welcome to the panel for prop tech and digitalization of real estate. We have a great panel today with some real estate veterans and people from the VC community to talk about how technology is changing or is going to change the real estate world. And as we live through COVID and a post-COVID world, people are focused on really what changes are taking place in their portfolios from both an owner perspective and an investor perspective. I think people are much more conscious of sustainability and carbon footprint and other things, kind of almost a new perception of what we have to think about with our real estate portfolios. So we have a great panel today. I'll make some introductions and then we'll walk through some of these different topics. But to start, I have SCHWARZMAN. Schack is a general partner from MetaProp. He joined MetaProp in 2016 from Gotham Funds, another VC fund. MetaProp is the most active early stage investor in prop tech today, and they have invested in about 100 real estate tech companies. Zach's going to talk from kind of the investing side, what they're seeing in terms of different technology and different platforms. We have Bill MEANEY, who's president and CEO of Iron Mountain. Iron Mountain is an information and data center company. He was previously the CEO of the Zulig Group. Did I say that right, Bill?
Yes, close enough, yeah.
A $12 billion B2B or business to business company in China, which is interesting. For those of you that don't know, Iron Mountain is a $22 billion company. They have 1,400 facilities around the globe in about 56 countries, 93 million square feet in total. So big global portfolio that we'll love to talk about. And then Victor Coleman is chairman and CEO of Hudson Pacific Properties, HPP. HPP is a West Coast office REIT. They own about 53 office buildings on the West Coast and 3 studios with 35 sound stages with really a focus on media and tech and entertainment. So welcome all of you. Thank you. I'm KRISTIN Gannon. I'm a managing director at Eastdil Secured out of our San Francisco office. I run our M&A and corporate advisory group. So I was going to start with the topic of COVID, like everybody does, and wondering as we kind of transition what I hope is out of the pandemic, but dealing in a new post-pandemic world. Want to talk about kind of how your business models have evolved. Victor, I thought maybe I would start with you, whether demand drivers have changed. I know you have a lot of focus on your buildings and safety and health, but maybe you can summarize some of the things you're doing and what's really changed over the last year.
Sure. Thanks, KRISTIN. Hey, Zach. Hey, Bill. Thanks for having us. So listen, as I think you probably all know, so we've differentiated ourselves on quality, right? We're West Coast. Our tenant mix on the West Coast is pretty much media, tech, and entertainment. So, the difference in Class A versus Class B assets and what we've done is, for the most part, because of COVID, we put tremendous amount of amenities that were sort of earmarked throughout a period of time and try to expedite it, been very tech forward around safety, around protocol, and we've had obviously, ample time in getting prepared for that. Our sustainable platform and leadership has been something that we've been working through it. And I think as a result of us and what's happened during the pandemic, we expedited a number of different processes that got us to where we are today. First was, we implemented a new mobile app for our tenants, and we got that done. It's called My HPP Office app. We got that done as a one-stop building access, overall communication, safety, security, health. We interacted it with our large tenants like Amazon and Netflix and Google and the likes of that. So we rolled through that post-COVID 30 days out. We rolled this out, streamlined the communications uniformly across the portfolio, and then we got to message it back and forth. And as a result, we've created this platform around a differentiator and a secured environment that as things change in this post-COVID world, quality, we feel, is going to win out, and the communication around the quality and safety and protocol. We've implemented, obviously, investing, which we will talk about, in prop tech ventures, entities, the likes of that. We've also gone out and invested with VTS or with other aspects as well. So that sort of gives you a feel how we've taken it. It's a go as you go process, KRISTIN, as you know, and I think as voices are getting louder and people are getting more comfortable, getting prepared to come back to work, information is going to flow much quicker around safety protocols first, but then more about comfort and indoor, outdoor. And since we're West Coast based, from Vancouver, Seattle, San Francisco, and LA, we have that ability to adapt, and we've been beta testing that throughout the portfolio. So that gives you a little idea of what we're doing.
That's great.
I think we can mute, by the way, because there's background. So I'll mute.
I'm going to mute. Bill, what about you? Running a global company and focus on safety, especially people coming in and out of your facilities. Would love to understand some of the changes you've had to implement.
Yeah, no, thanks, KRISTIN, and it's good to see everyone. We're in a mainly industrial business with data center, right? So we don't have tons of people coming in and out of facilities that are our own folks. I think we're also, in some sense, in a crisis like this that turned out to be a pandemic. We're blessed in the sense that, as you say, we're global. So we're in 56 countries across the globe. And as you know, this started in China, in the Greater China area. And our folks were already dealing with it in January. So we were already establishing protocols initially in the Asian region based on the disease in that specific location. And most of our Asian employees have a lot of experience with this from SARS in 2003. So, in that sense that, having an Asian operation when this thing hit, I think gave us a leg up in terms of keeping our employees' safety. That being said, we have been impacted in terms of employee safety because we have 24,000 employees around the world. And, a number of them have fallen ill. As we sit here today, we have 3 people in hospital. So it is something that I get a daily report in terms of country by country, location by location, how many employees have fallen ill, how many people are recovered, and how many people are gravely ill and in hospital. So it is something that we track. But in terms of having the protocols so that people can maintain the operation and keep themselves and their families as safe as possible, that we're lucky because we saw it coming, so to speak, and we have experience in that region, especially because of SARS in 2003, which was even more deadly. The other aspect about safety for us is we have a big occupational health issue, right? Because of the nature of the facilities, whether data centers or whether it's in the industrial location. So the other thing we're worried about, though, is when you add another threat of safety, in this case, an invisible virus. Was that going to go off kilter? And, I'm happy to say that our folks, we made sure that we constantly spoke about safety. And our folks, actually, we saw occupational health statistics improve all during COVID. So I think the heightened discussion around it really helped. I mean, the last aspect about safety and health, of course, is the mental health. And that's the thing that we probably spend the most time speaking about internally. We have pretty much comprehensive health benefits around the globe for our mountaineers or our employees. But, it's one of the things you can't speak enough about because sadly, there's still stigma associated with that when people feel stress. So as I sit here today, I'm probably the most worried about the mental health of our employees. But overall, we fared pretty well, even during the depths of the crisis. Right now, 100% of our facilities are back open and operating online. But even during the depths of the crisis, 96% of our facilities remained open. And early on, I received letters from a number of our customers, mainly in financial services, reminding us that we had an obligation to serve them even during a pandemic, because we're considered part of the critical infrastructure for most financial service companies.
Okay, great. Zach, I'm curious if you're seeing, kind of consumer trends and even, the use of real estate change as a result of COVID. So almost, how people are consuming and operating real estate. Has that changed, and is that some of the technologies you're investing in?
Yeah, it's a great question. Also, I'll echo the great to be with everybody today. So yes, I mean, obviously it's a large period of flux for the real estate, potentially one of the large, certainly in my career, and I would say joint memory. And so that is micro implications in different asset types, but I think the largest sort of cut across implication of it is demanding a level of flexibility, of coordination, of data, visibility, control, that is not necessarily natural for the real estate industry as a whole, which historically, just the way it's organized, is much more long-term oriented. Assets are not incredibly nimble and flexible once built, and end up shifting preference sets, shifting regulatory environments, shifting consumer sentiment, and it's all happening at one of the fastest paces one can imagine it had. It's putting a lot of strain on operators. So you see that with everything from geographic headwinds and tailwinds, right? And how much of that is going to be permanent, and if you're planning your office footprint, if you're planning new residential development, where are you doing that? Are you planning for what's happening immediately today? Which will things shift back? What is the future of office occupancy going to look like? You be repurposing retail assets? How much of that is going to become a blend, brick and mortar retail in a traditional sense and industrial and logistics? Those are big, weighty decisions. They require tooling to actually make them happen, and they also require a lot of data to inform what choice you actually make as an operator, as a developer of assets. Some of the areas that the strongest tailwinds are all things residential, and most things industrial, logistics, and warehousing. Those are areas that are seeing rapid investment. That's investment that's happening in industries. It's also investment that's happening in the technology layers to support a lot of the activity there. We see a lot larger question marks and more numerous question marks around things related to office, to some extent related to multifamily, more in terms of configuration and the health of the and asset class. But again, we also see investment in the technology layer there to help the industry transition through a fairly rough period. So from a tech standpoint, it's an interesting dynamic where, regardless of whether your end industry segment is booming and seeing huge tailwinds, or whether it's trying to navigate a lot of headwinds, there is, albeit in different flavors, a large appetite for a lot of technology to help with both capturing the opportunity as well as the numbers.
Okay, great. Bill and Victor, you both talked about some of the safety and health concerns coming out of and what that may mean for your operations. But what about business model wise? And maybe I'll start with Bill. I know you've started kind of a digitization of your portfolio, kind of combination of both physical and digitizing, your documents and all. Has that accelerated as a result of COVID? Does that continue? Is that a big, kind of growth area or segment of your business going forward?
No, it's a really good question and point. So it has, which is probably not surprising because companies are accelerating their digital transformation, especially they almost had to out of necessity because they needed to figure out a way that people could work from anywhere when they couldn't have access to their offices. So everybody was looking from a business continuity standpoint. How could they access both their physical and digital information in a highly secure way? And how could they keep track of that in that type of system? So luckily, a lot of the things that we had been working on in the last 5 years in terms of product development, looking at how people manage a hybrid digital physical world, really started coming to the forefront during that period of time. And it's better to be lucky than good. We also set up a new sales organization back in the back half of 2019 to really, with people who come from Accenture, IBM, HP, SAP, and those types of organizations so that they could actually interact with our customers in preparation for selling some of those kinds of services. And of course, the crisis comes, and that was really at the forefront. So what we actually saw during the crisis is our storage stood up, as you probably expect, really well. Our data center business grew at an unbelievable rate. I think it's, to be honest with you, less to do with COVID, much more in terms of the acceptance and the excitement about our product offering and the geographies that we have. And so, we signed up over 58 megawatts in 2020 of new leases, where we guided the market. We thought we'd do 15 to 20. And just to give we're still a relatively new company in the data center space. We have about 130 megawatts of leased up capacity as we ended 2020. So, we expected to have 15 to 17% growth, let's say, during the course of 2020 of new leases, which is pretty fast. And we end up with 58 megawatts. But coming back to the traditional side of the business, where we still have a very large paper document storage business in this hybrid services, is that what we saw was the storage stayed up on the physical side, but the services, in other words, people weren't asking for us either to pick things up or drop them off to the offices because they weren't there. So, but what they needed somebody to help partner with them so that they could get access to that information in a highly secure cloud-based way, whether it was digital or whether it was physical, and they needed digitized so they could get access to that. So that business, so at one level, our physical service activity, if you will, dropped by, at one point, over 40%. Towards the end of the year, it was about 20% down. But our digital services grew at 8%. And we've already guided the market. It'll be, a strong double-digit growth again this year in terms of our digital services, which is really about allowing people to work from anywhere and to be able to auto-classify the information that they have so that they can actually put governance around it.
Interesting. Victor, what about you, kind of from a strategic angle? Are there changes you're making in terms of the fit out of offices if we're potentially dealing with people only coming back to work a couple days, or are you redeveloping into more techtainment where, you may have studios and other media, using space more often? Is there any kind of changes as you look from investing and developing going forward?
Yeah, well, let me take the latter part of that first, Kristen. On the studio side, obviously the voracious appetite for content is at a pinnacle, and who knows when it's going to slow. I mean, this has been an amazing time for absorption of content, and now the creation of content is backlogged by 6 to 12 months, right? So our facilities are running at full force, even though people aren't fully in the office, but the production facilities are going. And so our markets, are the center of gravity for the media tech content reality growth. And so we're seeing demand on content, space around content, and utilization of space, and then the effectiveness of new development. So we're currently in the development phase on 3 different projects for 500,000 square feet each, 2 in Los Angeles and 1 in Vancouver, of stuff that we've owned that we've entitled, and the focus has been clearly different, right? It's looking for, much more of outdoor utilization. We're building a facility in Los Angeles for about 700,000 square feet for Google, and almost 45,000 square feet of that is outside, fully utilized outside space that they're paying for. This was pre-COVID, and now it's sort of come to fruition. We'll see how the expansive footprints are going to correlate to strategic, aspects of how companies want to see what happens going forward. Clearly, the temperature line is not there yet as to people's comfort zone of coming back to work. But as I said earlier, you can feel that momentum. People are talking about expanding what was, the definition of creative office campuses was typically, more people and less space. Now that equated to almost down to a point of like 175 feet per person. Now we're seeing companies revisit their floor plans and trying to expand the amount of square footage. And that's going back to like 250 a person now, or something to that effect. And so it's to be determined what people are really going to sort of be comfortable with. It's obviously going to run around protocol and safety, like we said. As a company, we've tackled a lot of aspects for encouraging the comfort levels, whether it's dealing with systems units or MERV 13 or BIPVs or the likes of that, all these aspects to get safety and clean air and fresh aspects around people in space needs to be addressed prior to. So the money's been spent. We're now waiting for butts in the seats, which we think is imminent.
Good to hear. I'd like to change gears a little bit and move more towards a discussion on sustainability and carbon footprint and climate change, which continues to be a big topic, and I feel like is accelerated through COVID. And so, Zach, I guess I might start with you. REIT shareholders have been focused on sustainability on various levels, but including environmental and climate change. Is that a technology you're seeing your investors focused on in terms of helping people implement some of these sustainability plans?
It is. It's been a growing topic of conversation for a little while now, and the voice is clearly getting louder. I look at it and I see four drivers of this, right? The first is, and hopefully paramount, is a moral imperative to do so, given the outsized impact that real estate has when it comes to carbon consumption. And the second is been a long-standing one, but it's certainly come back, which is economic driver, right? You have, hopefully when done well, you have both expense redundant, and in some cases, you actually have incremental revenue generation opportunities that come from some of these sustainability companies, right? I mean, we have, companies that not only allow folks to use some of their on-site, on-prem energy generation storage resources to be able to cut down their own external energy demands, but actually enable them to sell excess capacity back into the grid and further monetize those assets and turn them into incremental revenue streams. So you see the promise of some of these technologies. You also have increased, and it's fragmented, but it's certainly moving in only one direction, regulatory pressure to invest behind greater sustainability efforts. I mean, in New York, where we're based, local law 97, that's a real stick to, incentivize building owners to upgrade their sustainability efforts and minimize their energy consumption. And for large players in the REIT world, they have the resources to tackle that challenge. It is a heavy lift, but they have the resources, they have the organization and the balance sheet. For longer tail landlords that are subjected to similar standards, that is a path without a guide oftentimes. And so there is a real demand there from the longer tail of the real estate industry for a little more plug and play help and consultative guidance to help them along that journey. And the fourth, which is interesting because capital is generally a trailing indicator, but capital has really been a leader in this regard. And there is, as there's a resurgence in interest in clean energy and clean technology, a lot of that is being led by a huge amount of ESG appetite in the broader capital markets and folks who invest into innovation funders like folks in the venture capital community. And so there's pressure there as well to respond to that capital.
KRISTIN, let me just jump in on that real quick, because by the way, I completely concur with what Zach's saying. And before I sort of talk about the climate change, I think his point about capital and accessibility around the REIT structure and other institutional owners in all facets is a massively important one, because before you can put guidelines in place, you have to make sure people can adhere to those guidelines, and capital is the key. And so you can't put climate tech up in front of everybody's position to adhere to when you have a massive amount of capital needed to go into older assets with owners of those assets or publicly owned real estate that cannot afford it. And so those benchmarks need to be evaluated very particularly and timed very, very efficiently before people can get it can actually take charge on it. Now, loosely speaking, like climate change is anything that contributes, what is exactly what Zach said, to reducing, our global greenhouse gas footprints. And that's what it is. And so, at our company here, we're really focused on the convergence of prop tech and climate tech. And we have spent real money on that. And the money that we've spent to decarbonize our buildings, to accelerate our carbon neutral strategy 5 years earlier, and we're 100% carbon neutral now that we did at the end of 2020. It was a 2024 goal. I mean, that takes real money, and a huge amount of that capital flowing into our space. A lot of it is exciting technology that's out there that Zach sees every single day and invests in, but it's also investments that we're going to get a return on. And yes, there is the ESG aspect of what we should be doing and what people will only invest in us because it's the right thing to do, but we are getting return on those investments. And that's the key. I mean, we have on-site renewables. We're seeing, companies like Turntide, which is electric motors. I know, I think Amazon just invested with them, new HVAC motors that speak and communicate efficiently throughout assets. Material innovations like carbon cure and things like that, which is truly sequesters the carbon out of the building concrete on an efficient way. I mean, those are investments that will go a tremendous long way. But as I said, even with electronic vehicles, that Lucid just did with their SPAC deal. Also, I think that was a Zach and Amazon investment because it's profile. All this is going to come together over time, but it needs to be, for companies like us, it's on the forefront and we're prepared to spend money, just as Zach said. But, we have a joined, science-based target initiative, and we would encourage others who can afford to do so, but you can't expect everybody to do that. I mean, this is a process that's going to take some time. And I think people need to be smart about energy efficiency and retrofits. I think they need to invest in, climate tech in our buildings and their own assets as well. But, tackling carbon embodied aspects and steel and other areas of material or new construction is not for the faint of heart unless you're going to see the return. And the return is going to come twofold. One, direct bottom line return to the environment and climate change. And two, certain tenants, like a lot of our tenants, will invest with us and go in our buildings because we have it, and they're prepared to go, shoulder to shoulder and pay for it. I mean, Zach, don't you concur?
Tenants will demand it, but pay the higher rent, right?
Yeah. Well, they don't demand it. They won't go there unless you have it. I mean, that's the bottom line.
But the bulk of
100%.
the office portfolios, older portfolios, right? Where I'm assuming it costs more to retrofit and bring in these energy efficiencies, right?
Yeah, listen, I've been a big proponent, and listen, I am talking my own book, but I have to say it anyways. This cycle, whatever this cycle will adhere to, there will be a big difference between A's and B's.
Yeah.
The A's will attract tenant and rental rate growth and aspects that landlords are prepared to put money in, and the B's will not. And that there should be a big differentiator when before, in all markets, not just certain markets, when before that wasn't the case. And I think that's going to prove in this next part of the cycle to be a big game changer.
Makes sense. Bill, I know you guys have various programs on the green and carbon neutral basis. Can you talk a little bit about and maybe some distinctions in Europe versus here in the US?
Yeah, no, it's a good question. We're a little bit in a different category in the sense that this has been something that's been front and high on our agenda probably now for 7 or 8 years, almost as long as I've been in the company. And we've been issuing sustainability reports pretty much that whole time. We're in the FTSE for Good. We're signed up for the science-based targets a few years ago. I think it was in 2015. So we've been at it for a long time, and partly driven by, and for us, the sustainability is across ESG. So it's E, S, and G, right? And part of the social sustainability has really been about making sure we have the best talent, because we need 24,000 people around the world. So if you don't speak to them and make sure that you're driving a diverse and inclusive workforce, is quite frankly, we'll struggle in terms of keeping those positions. So we've had a very strong kind of sustainability look for a long period of time. But if we look specifically at the E in the data center business, so the not too well kept secret is data centers emit more carbon into the atmosphere than global aviation. That's even pre-pandemic. So this is a major contributor to greenhouse gases. So we just, once we started getting into the data center space, we said, look, this has to be high on our agenda. So I mentioned the science-based targets that we signed up in around 2015, that we said by 2025, we would reduce our carbon footprint by 25%. Well, by 2019, we had reduced it by over 50%. And we're now committed that we'll be carbon neutral by 2040. And how are we doing that? Is there's really kind of three buckets the way we look at the way we're focusing on getting to carbon neutral as a company. The first bucket is kind of some of the things that Victor and Zach just touched upon, which is what I kind of the usual suspects. That's going in and making sure in your industrial places you have all LED lighting. That's looking at our data centers to make sure that we're using the most efficient cooling and both motors, pumps, and the mechanism that we're using for cooling, combination between air and water, because we're also very sensitive in terms of water usage. So all of those things are things that we factor in, which I kind of call those are kind of the low-hanging fruit. I mean, it's a moving low-hanging fruit because technology does move in those areas that allow you to continue to make your facilities more and more green, but that's one aspect. The other part of it, I should say, is the way we're building our facilities, but I would say that's also, there's a lot of that when we talk about low carbon concrete, because we obviously use a lot of concrete to build our data centers. A lot of that technology is just emerging right now, but we are very conscious also, not just the way we run our data centers, but what it takes to build them, because there's obviously a big carbon impact in terms of the construction. The second bit, which is really the thing that gives us, that's driven the fact that we've reduced our carbon footprint by over 50% in such a short period of time, are PPAs, or purchase power agreements that we've done to fuel effectively our data centers. So we're more than 100% covered for all the power that we use in terms of our data centers globally. So we're in 3 continents, the United States, Europe, and Asia. And I said that we have about 130 megawatts at the end of last year already running. So that's more than 100% covered through these purchase power agreements, which average 15 to 17 years out. Unfortunately, it isn't always a one-to-one match. Obviously, we're selling that back into the grid, depending on where those windmills, solar facilities are that we've actually purchased in long-term agreements. And if you think about the cost of that, it's definitely it's probably cost neutral. I mean, we're taking a risk on the duration because obviously we're taking, fixed power prices for a very long period of time. But but by the time we lay off some of that risk through derivatives, is that it's kind of a neutral thing, because one of the things that's really important, we were talking about customers, and I'll come to the customer aspect in a second, is customers are not going to pay you more to run a data center for them because it's green, but it's becoming table stakes. It is a differentiator when you're actually speaking to the large customers. So for instance, customers that we can speak about publicly as our data center customers are the likes of the Boeing Company, Goldman Sachs, Credit Suisse, Akamai. All these people agreed for us to use their name because not only are they happy that we're running our data centers 100% carbon neutral, is we're able to pass those credits through to them with something that we actually created, but is available to our competitors as well. But we were the ones that actually put it together, which we call the Green Power Pass. So we're able to actually not only run our data centers on our carbon neutral footprint, but we're able to actually give those credits to our customers. And, for instance, the Boeing Company, this was super meaningful because that data center that they had that we host for them is very, very large. And it was, noticeable in their own sustainability report. And then the third bucket of where we work is more what I would call the R&D, which is, and some of those are the things that we're really going to get at that gives us the confidence again for the 2040 target. And some of the things in the R&D is about a year ago, we started electrifying some of our vehicles. So that started a little bit over a year ago in Europe. You mentioned Europe, as we started in Europe with electrification of vehicles. That experience and understanding the economics of running electric vehicles versus vehicles run by fossil fuels has given us you would call it the roadmap or the blueprint so that we can electrify, if not all, but most of our vehicles over the next 10 years or so, 10 to 15 years. So we absolutely know how the economics work. We know which routes they work on the best, what levels of technology we need when we roll it out into specific use cases. The other area, I mentioned, we're looking at the construction materials, is that, concrete is probably one of the worst construction materials that any of us can use. So there's a lot of technology and a lot of research that's going on into that. And then the other aspect, which, I talked about data centers in terms of they use a lot of power, but the backup generators, these big diesel gen sets that you have. In Europe, for instance, it's getting more and more difficult to get permits to build data centers because of the permits that you have to have around the diesel gen sets. Because even though the grids are super reliable, you still have to exercise those diesel gen sets. So in places like Singapore, for instance, and also in Western Pennsylvania, we're investigating using fuel cells, hydrogen fuel cells that would allow us to do that. So hydrogen, is a lot of articles recently about hydrogen and where it works and where it doesn't work, but it's getting to be super interesting for certain use cases like backup power generation, and sometimes even as a primary source to fuel a data center. And there's quite a bit of work being done with the likes of Air Liquide in France, the chairman and CEO of that is part of the Hydrogen Council, as well as SK Group, which is a chaebol from Korea, is doing a lot of work in that area. So, those are kind of the three different kind of buckets that we think about it. But, I have to give the team a lot of credit as we've made some really good progress. But in data center, it's more and more, it's not quite table stakes, but it's getting that way because of the concentrated pollution that comes out as a result of running a data center.
Really interesting. You sound far ahead of the curve. So thanks. Very interesting. Why don't we turn to kind of the capital or investing side? And Zach, you know these numbers better than I do, but 2020, it looked like about 25 billion in investments in both climate tech and prop tech. It was down from 19, but a huge interest. I think it used to be about $1 billion 10 years ago. And there's major real estate institutions investing in some of these technologies. We saw Ivanhoe Cambridge and PGIM announced going into fifth wall. So Zach, I know there's a lot of capital focused on it. I know you guys are raising a lot of money. Where's that capital focused in terms of where they want to see their dollars being invested in climate tech and prop tech, and maybe some examples?
Sure, happy to. So I think it's important to have just a big picture view of where are we in this cycle. Prop tech is a buzzword that has only been around for a couple of years. This is an industry category that barely existed about 5 years ago, right? We've gone from under $1 billion invested in any given year in the beginning part of the last decade to well over 10 billion invested in any given year. At the end of it, it's one of the fastest growing segments of tech. Where we are today is tech as a broader space outside of prop tech has been one of the largest clear winners in the disruption caused by the COVID crisis over the last year. The amount of innovation that's been pulled forward from years or decade plus to weeks and months is pretty well noted at this point. And to wit, you had a almost complete seizure of the capital markets in Q2 of last year. Last year still set a record in aggregate for the amount of venture capital dollars invested in the broader tech landscape, right? So even missing a quarter effectively, it was still a record year. Prop tech's been one of the fastest growing segments within broader tech space. It was already on a real run. COVID has acted as a huge accelerant for the amount of money that's coming into the prop tech space. It's coming in from a couple of different places, or seemingly everywhere all at once. It's coming in from the traditional real estate community, and that's been happening for a period of years. So if you look at, our business model at MetaProp, if you look at our peers at firms like Fifth Wall and others, it is very much raised a very visible portion of your capital from the real estate industry itself, folks who represent the customer and partner base within the real estate community. Originally, that represented the majority of the capital coming in. Now, as some of these investments really prove out, the funds are maturing, they're performing very well. The individual investments are going from small seedlings, right? Companies with a couple of dozen people to companies that have hundreds of people are producing tens, hundreds of millions of dollars worth of revenue and are now exiting and seemingly exiting en masse with the rise of SPACs over the last couple of quarters, which is a fun topic all unto itself. Now you're seeing a huge amount of realization of capital, and all of that momentum and growth is one, exactly what you'd expect to see in a healthy but new emerging tech industry category. It's exactly what I saw in the beginning of part of my career coming of age in the New York tech ecosystem when it was growing from very, very small to quite established. Same trajectory. And it also is a huge magnet for traditional allocators of capital into the venture space who aren't only looking for the returns that a real estate firm might be looking for from investing in tech, which are primarily, in addition to appreciation on capital, access to new emerging technologies before the rest of the market and influence over the direction of those technologies. Now you have investors coming in who are purely yield seeking, and they just say, we see it. We saw it with fintech in the last decade. We see it with prop tech today. You have a giant end industry that is behind the curve when it comes to technological innovation and adoption. It spends almost nothing internally on R&D. All of the change is going to happen in terms of external innovation dollars, and that is going to be done by the venture capital investment community and entrepreneurs outside of the four walls of real estate organizations, and they want a piece of that. And so a lot of that capital is now flowing in as well.
So Victor, I know that Fifth Wall did a SPAC. I'm assuming there's others, and it sounds like, Zach, that's driving a lot of the takeouts, right? Or as you said, kind of conclusion of some of these early stage investing. Victor, you think we see more of that? Does that kind of propel new technologies? Does it expand what's being done in climate and prop tech?
Yeah, so let me make one comment, because I love Zach's numbers, because they're absolutely 100% accurate. And then people say the death of office is the future, when all these tens of billions of dollars are going into the system, which he said. I mean, that is exactly it. Companies that were at 5 and 10 people are now 100 people, and they're not all going to be working from home. So let's just concur with that process, that interaction, collaboration is part of this process. But yes, so we invested with Fifth Wall in their second fund for 2 reasons: access to product that we can co-invest and implement, 1, and 2, making a return on our capital, because they invested and they're going to continue to invest in interesting aspects. We've invested with others at the same time. I think climate funds are now the next, in addition to the prop tech funds that are out there. Climate funds are the next aspects, and they're also, people are investing in them because of exactly what we just talked about. But I think the future aspects of checking a box to doing the right thing and making a return on your money, it may not be the same clearly as where the prop tech valuations are going. But we are living in a very unique time in takeout with SPACs and other accesses to capital, and a very, very favorable, leverage market out there for people to capitalize on, and the ability for people to execute on pipes. And so you're going to see a lot of that. And I think at the end of the day, it's going to make efficiencies and cost effectiveness a lot better in all forms and functions of real estate. And as a result, it's catering to the younger executive, the out of college, who are prepared to take advantage of all these aspects, both in new businesses and in their homes, and every other aspects all the way through. And so I think it's an exciting time, and a lot of money is sitting on the sidelines. And clearly, some of it's going to be spent the wrong way, but a lot of it's going to be spent the right way. And I think if the days of landlords just collecting checks, that ended a long time ago. You're going to have to reinvest that money into your assets at any different level of real estate that you own, for you to attract the best and the brightest and the highest quality tenants.
And I'm curious how much collaboration there is in the, kind of real estate sector. Victor, I was thinking back of, I don't know when it was, 99 or 2000, when a bunch of REIT, big REIT CEOs got together and did the collaboration vehicle for .coms, invested in broadband office. Do you remember that? Yep. Constellation. And they invested in stuff, and I hate to say it, a lot of it blew up. It was kind of e-commerce plays and other stuff. But is there more collaboration, especially on things like carbon footprint and the right technologies and the right way to spend capital, I'm just curious, Bill.
Well, I'm going to make a comment and then I'm going to have Zach jump in here because I think he's going to concur. But I can tell you there is no advantage to be first to market here. You just have to be in the market. And I think at the end of the day, you know, you're right. In 99 and 2000, when we were all looking to do that together, everybody was looking for that advantage. It's not going to matter. I mean, it's a matter of months now. It's not a matter of years that you're going to have to be up and running. Once new products come into play, you're going to have to adapt and embrace it. And you're not going to get credit for being there. You're going to lose credit for not being there and investing it, right? I would think that's how I look at it. Zach?
Yeah, I would very much agree with that. I mean, there are a couple of different pieces. One is today you have a lot of external innovation organizers, right? I mean, think of folks like us, you have Victor, your partners as well at Fifth Wall. Those are folks who exist outside the bounds of any one organization, and so they remove some of the pressure to collaborate directly with one's peers to bring about the next great thing and navigate the incentives that go along with that, and they can sort of take the charge there. But there are a couple of other things as well. I mean, one is one of the things that we've seen real estate organizations, large and small, try to navigate over particularly the last 4 or 5 years is how to balance knowing that in order to survive and to thrive in the next decade or two of their organization's life, they need to build a real muscle and competency around working with technology, ingesting it into their organizations, both at the asset and the operational level, exposing it to their tenants, their employees, all of that. But doing so in an environment where at the time, the technology providers that folks like us were investing in were still very small. And they were often, because they were small, they were fairly narrowly scoped in terms of what they were providing. And so one of the things that we would hear from the real estate industry all the time is, we like it, we believe in it, we want it now, we want it yesterday. But we don't want 25 different ones. We want kind of one place to go, 2 places to go. I don't want my tenants to have, 25 different apps. I want them to have a narrow set. And one of the things that we've worked with industry around is that is true. That is certainly coming, or something closer to that is coming in state. We're seeing a massive amount of consolidation happen in the market right now. But in order to really be positioned there, it's tough to go from 0 to 100. You've got to learn to build that muscle, to organize internal functions around how to prioritize what kind of technologies you want to go after, for what purpose. Is it for investment? Is it for vendor relationships? Is it for something else? Who within your organization is doing that? How is it resourced? How do you run sourcing and filtration processes, make decisions around procurement, organize, help scale out what works, generate organizational buy-in, let alone try to potentially make direct investments or acquire technology. I mean, that is a multi-year process for real estate firms to make. And one of the things that we hear all the time is folks looking, whether they're overtly asking for it or not, for frameworks around what their peers are doing, around how they're engaging with innovation. And I think as we've seen that, we have seen a lot of the barriers, the competitive barriers, come down, and folks become more directly collaborative with their peers as they have heads of innovation in their organization, people whose full-time job is to do this, and want to understand what are their friends and neighbors doing at peer firms to help move forward within their own 4 walls and have an external support system as well. So yeah, we're absolutely seeing that.
And just one comment on that, and that's why it's hard for companies like ours and Bill to a lesser extent, but because we are really trying to adapt and move forward to find people to come work for a real estate company who want to be involved in prop tech or climate tech or VC capital raise and implementation. I mean, the market is full of those people, but they're not coming our way. So it's hard for us. That's why we do business with partners like that, because we can't employ those people ourselves.
Makes sense. Well, great. I think we're nearly out of time, unless there's anything else anybody wants to cover. But I really appreciate all your input and insight. Interesting panel. Appreciate it.
Yeah, the only thing I just would add, just not to prolong, but just to Victor's and Zach's comment, is I think it kind of depends, and we're probably not the right benchmark for a lot of these things because we're probably more like FedEx than we are like Boston Properties, if you will, right? Is that in the sense that, our CTO came from Nielsen. So, our view is that we need the technology both offensively and defensively, right? Just because we have to have a competitive product offering that we can actually run our operations efficiently at the right, cost point so that we can get the right margin at the end of the day. And we also use it as offensively to disrupt, right? So, what I was talking about, our ability to be able to allow people to work from anywhere. We actually were Google's AI Partner of the Year, I think it was 2 years ago, because we built that tool together with Google, which just so happened, good thing we did it 2 years ago, because now people really want that platform. And that's the platform that we're allowed. We helped a state in the United States, for instance, be able to issue all their unemployment checks during the peak of COVID back in the April timeframe. We did that over a 10-day period from handshake to implementation, and 800 of their adjudicators were working remote from the office, remote from each other, and we were able to put that process together. But I think that's, I understand what Victor's saying is, how do you actually attract like the CTO from Nielsen into your company if that's not what you're doing? But I do think that gives you an advantage if you can figure out how to do that in terms of where the thing's going. And then I said there's also a big defensive side of it, right? Because we do need to have, we're moving our whole ERP stack to Oracle Cloud, right? And in that we need to be able to drive that level of standardization across the board, because, if you're competing against logistics companies for big parts of your business, if you can't do that, that's a problem, right? So it is, so I agree with Victor and Zach, is that how to do that. I would say that we are even at a competitive disadvantage because we're not as sexy to work for as Google, right? And we need some of the same types of brains around some of our aspects. So, a lot of it's going to require partnerships either with, startups that financial sponsors are actually bringing to the market, or in other cases, established players.
Yep, makes sense. Okay, well, thank you all. Appreciate your time, and hope to see you sometime in the near future.